This week's theme on the Retirement Quick Tips podcast is Are the days of ultra low interest rates gone for good? Today, I'm talking about how to invest in stocks in a higher for longer interest rate environment. Investing in stocks is a lot more challenging than investing in bonds in this higher interest rate environment. If rates stay a bit higher for longer, it's a bit easier to figure out what's going to happen in the bond market. But if rates stay higher for longer, how's that going to impact stocks? Broadly, overall, what's the impact on the general stock market? Well, the first way that higher interest rates impact stocks is that all else being equal, higher interest rates makes stocks more expensive. Many stocks are already at high valuations even before interest rates went up. So higher interest rates just makes the valuation problem worse. And that's because the way stocks are valued, it measures the cost of capital for that company. So in a higher interest rate environment, cost of capital is higher, valuations go down, and investors basically aren't going to be willing to pay as high of a price for stocks. And that's exactly what happened in 2022. You saw interest rates soar. You saw stocks fall across the board, many by as much as 30 to 35%. And that was 100% fueled by the fact that the cost of capital was higher, and it changed what a stock was worth and what someone was willing to pay for it. So stock valuations are impacted by rising interest rates. Everything's already sort of baked in at this point. Stocks got a lot more expensive. The prices went down quite a bit when rates were going up. But what about when rates are sort of flat? They're not really changing a lot. That's basically the environment that we're in today. And, a lot of that repricing has already happened. There's an interesting quote by Rob Hayworth. He's Senior Investment Strategy Director at U.S. Bank Wealth Management. He said, quote, "Stocks may be somewhat expensive from a valuation perspective, but if economic expansion continues and earnings grow as they have recently, higher valuations can persist for some time." Okay, then on the other side of the spectrum, you have Warren Buffett at his recent shareholder meeting when he was asked, Berkshire Hathaway is holding on to more cash right now than they ever have before. Why? Well, in Buffett's own words, he said that they basically don't see anything that looks worth buying right now. In other words, things are so expensive, we don't see a need to buy something at the top here. And who knows what he's really thinking, because he kind of dances around it a little bit. But he basically says, look, everything's expensive. I'm not paying this higher valuation. Why would I buy something at the top? The other factor, though, that is complicating things with stocks is you have artificial intelligence. So there's been this huge upside surprise with the stocks in the last year or so, especially in the tech space. And a lot of that is being fueled by AI. We're also seeing innovation in AI, not just concentrated in the tech sector, but it's now trickling down to other industries outside of tech. Now, AI is a big, complicated topic, and it is scary in a lot of regards, but it's also an exciting thing too, because it can enhance productivity, it can enhance growth, it can enhance company earnings, all of which would continue to provide fuel for stocks. Now, one area that might hurt the stock market is something known as the TINA effect. So TINA stands for there is no alternative. So back in the days of lower interest rates, why would you buy a CD or a bond when you were earning like 1, 2, 3%? So a lot of capital, a lot of money left bonds because interest rates were so low and investors couldn't earn anything on bonds and CDs and money markets like they can today. And so a lot of that money went into lots of places like Bitcoin and real estate and other places, but it also went into stocks. And so stocks had this TINA effect where there was no alternative. So if you had a portfolio, if you had a 401k, a lot of people were higher in stocks than they probably should have been, actually, because they just couldn't earn that much money in bonds for a very long time. And so you have this environment where if rates stay higher for longer and people can earn 5%, if stocks are averaging 5, 6, 7, 8, 9, 10%, but I can earn a similar rate, 5% and much less risk, then a lot more capital is going to continue to divert more into money markets, CDs, out of the stock market, et cetera. So just the flow of money, because there is no TINA anymore, should impact stocks overall. The other thing too is that we have had above average returns in the stock market for most of the last decade. So as of April of this year, the S&P's average return over the last 10 years, annual return, was 12.6%. That's about 2% higher per year than the long-term average for a 10-year period. Okay, so we have this above average return, which I know is a little surprising because you had 2022 in there, you had the big drop during COVID. 2018 was a flat year for stocks. But yes, it was over the last 10 years, the average return has been above average by a noticeable margin. So everything generally goes back and reverts back to the mean. So you have this period of higher returns that we've had for the last 10 years. Stocks, now it may not happen right away, but they often revert to the average, right? The average return in the stock market really hasn't changed much in the last many, many decades, going all the way back to World War II. So in that environment, maybe stocks have a lower return. Maybe they don't crash, but maybe you're not going to get 12% per year. I wouldn't expect that. I would expect maybe high single digits would be more reasonable in this environment that we're in. Okay, the other last thing is that when you're looking at the stock market, not all of the stock market is overvalued right now. A lot of it is very expensive. But you have one of the most attractive and undervalued asset classes right now is value stocks. They have been unloved for years. They're not at the high valuations of many of the largest companies in the stock market. They are quality stocks. A lot of them pay good growing dividends. I talk about this all the time on the podcast, but the picture just keeps getting better and better for value stocks. And they look poised to finally make a comeback against growth stocks in this higher interest rate, higher for longer environment. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.